Did you know that some of the world's largest companies can shift billions in profits across international borders, all with a few internal price adjustments? Sounds crazy, right? Today we're cracking open the world of transfer pricing to see how it really works and why the governments are so keen on regulating it. Picture a big multinational company, let's call it Global Tech. Global Tech has subsidiaries all over the world. Maybe one in the US, one in Germany, one in Singapore, and so on. They sell products or provide services to each other as part of the normal course of business. For example, the Singapore subsidiary might manufacture computer chips, and the US subsidiary might assemble them into laptops. Now, transfer pricing is simply how Global Tech sets the prices for these transactions between its subsidiaries. Every time one branch sells goods or services to another branch, they need to decide on a transfer price, the price at which those goods or services will change hands. At first, this sounds perfectly normal, right? Companies sell to each other, so of course they need to set prices. The interesting part is that when these subsidiaries are part of the same global corporation, the prices they set can significantly affect where the profits appear on the books, and that directly impacts how much tax Global Tech pays and in which country. Let's say Global Tech's manufacturing subsidiary is in a low-tax country, and the assembly subsidiary is in a higher tax country. If Global Tech sets the price of the computer chips very high, then a bigger chunk of the profits from the laptop production might show up in the manufacturing subsidiary in the low-tax country. Conversely, if they set the chip price very low, then more profit will appear in the assembly subsidiary in the higher tax country. This can become a way for multinational companies to legally shift the profits to jurisdictions where they pay less in taxes, but if done incorrectly or unfairly, it can deprive countries of tax revenues that they are rightly owed. Now you might be thinking, this sounds like a huge loophole. Companies can just shuffle prices around to pay less taxes? Well, that's exactly why there are strict regulations to ensure fairness. Tax authorities worldwide enforce what's called the arm's length principle. This principle states that the transaction between related parties, like subsidiaries of a multinational company, should be priced as if they were dealing with independent and unrelated parties. In other words, the price should be in line with what you'd expect in the open market, no artificially high or low prices. Organizations like the OECD, i.e. the Organization for Economic Cooperation and Development, have guidelines on how multinational companies should calculate these transfer prices. Many countries incorporate these guidelines into their own local tax laws. So if you're a multinational business, you can't just randomly pick numbers that shift profits to wherever you like. You need thorough documentation and reasonable basis for your pricing decisions. Companies must keep detailed records showing how they arrived at these prices, and they often hire tax advisors or consult internal experts who specialize in transfer pricing. So in short, arm's length comparisons, where finding comparable companies or industry benchmarks to justify the pricing. Second one is the functional analysis, identifying which subsidiary does what, manufacturing, marketing, distribution, research, etc., and then determining how much of the profit is fair to each role. And the third one is the tax compliance, ensuring that the company meets all local documentation requirements in every country they operate in. Failing to do these things can lead to tax penalties, legal disputes, and a damaged reputation. So, let's recap. Transfer pricing is the method multinational companies use to set prices for transactions between their own subsidiaries around the world. This pricing has a big impact on where and how much tax is paid. Governments care about transfer pricing because they want to prevent profit shifting and ensure they collect their fair share of taxes. And rules and guidelines, like the arm's length principle, exist to keep it all fair and transparent. That's why transfer pricing is such a major focus for tax authorities everywhere. It's not just an accounting exercise. It directly affects the tax revenues of entire countries. I hope this video helped you understand what transfer pricing is and why it matters. If you're running a business or planning to start one that operates internationally, it's crucial to be aware of these rules. And even if you're not, knowing about transfer pricing gives you an insight into how multinational corporations operate in the global economy. If you found this video helpful, please give it a thumbs up and subscribe for more easy to understand breakdowns of complex financial business topics. Thank you for watching, and I'll see you in the next video.